Hello and welcome to BQ Prime. You're joining us on this special broadcast where we are talking about certain clarifications that have come out from HDFC Bank on Friday. Now, the bank pointed out that it had received clarifications from the Reserve Bank of India for certain dispensations that it had asked the regulator for, specifically those relating to priority sector lending arrangements, as well as statutory requirements on liquidity. Those clarifications have come from the RBI. It's sort of a mixed bag, but largely a positive for the bank. The bank has gotten the dispensation that it needed on PSL. It has gotten certain dispensations with regard to the stake held in its subsidiaries, especially the life and general insurance companies. However, those dispensations sought for CRR and SLR requirements, those were not given by the Reserve Bank of India. There, the bank will have to maintain whatever the ratios are as of date of the merger with HDFC Limited. Now, to discuss more about this, we're joined by Ms. Kajal Gandhi from ICICI Securities. Welcome, Kajal. I just wanted to first quickly get your view on the overall sort of view with regard to the Reserve Bank's clarifications.
So when we see an overall view, the impact has to be positive because when it comes with point by point information, it gives a lot of clarity and removes a lot of hay which was there on the stock on because of this merger clarity. Market was long awaiting whether RBI will give some relaxations or what RBI will say, particularly for subsidiaries. So I think giving the full transfer with a decent stake, the relaxation on BSL, marginal impact because CRR SLR is not given, but should overall be positive.
Hmm. Okay, let's start with the first big one that they announced with regard to PSL. Now, there the bank is allowed to meet one-third of the PSL requirements within 1 year of the merger date, and then another third in the year after, and the last third in the fourth year following the merger date. I'm just trying to understand, is this timeline enough to meet? Because it's a large portfolio that's coming into HDFC Bank. It's about 7 lakh crore, if I'm not wrong. So if that is going to come in, is that time enough to meet the necessary PSL?
So we cannot say exactly enough, but what we can think is that some bit of affordable housing which HDFC Limited is doing. So almost maybe almost now I think one third portion may be there which can get somewhere or the other way classified gradually. So that portion is also a positive that they can take that as PSL. I think 3 years guideline, they will have to work or buy PSLCs also, which the management has also clarified. RIDF may be the last option, but they may go for PSLCs or some buy of assets which are classified as PSL, and maybe slight drag on the margins, but I think they'll try to cope up as much as possible. So as of now, not enough numbers are there for calculation, but we believe a 4 year time frame and for maybe 4 lakh crore kind of book because the rest may have got some part of affordable and other things to take care of. So that way, I think 4 years for this may be able to manage.
Okay. Uh, you mentioned margins, but there's also cost impact for getting the PSLC, and of course that shows up in the margins. But overall cost to income ratio, when HDFC Bank announced its results for the fourth quarter, they said that they peaked at about 42%. Do you think this 42% is going to last for longer then?
So possibly, yeah, I think a year more we should expect the higher cost to income ratios from the perspective that they will also have to do this lot of merger related activity that is also a cost on the PNL. And secondly, I think uh, getting the lower yielding housing book and which is a more of a secured portfolio
Correct.
and this PSL guidance to be met, which is right now not there baked into the PNL.
Yeah.
These two things will have some impact, and overall cost to income ratios to somehow will remain high. I think at least for a year from the merger also. So we should believe that. Though when we say one bank getting such a large secured portfolio at one go will also open up their space to go for more unsecured loans.
Correct.
Because as a percentage on the total balance sheet, now you'll become more secured. I think the second bank or the bank which has such large housing portfolio is only SBI.
Hmm.
For a bank at this size with such large housing portfolio will be HDFC Bank only. And so that opens up for them other avenues also. They can
Understood.
also go and securitize and further do other things.
Yeah, okay. So that probably could help with the cost angle of it. Okay. Coming to the reserve ratios, CRR and SLR requirements. Now, the bank in the analyst call that they hosted on Friday, they pointed out that they already are in excess. SLR is about 24-25%. They've got LCR of about 115, lakh crore on their portfolio. Do you think that is enough now that the Reserve Bank of India has refused to give them any kind of dispensation?
I think what numbers they are suggesting it looks like, and they are also doing that aggressive part on the deposits. So we have seen
Mm,
20% deposit growth, no other bank doing apart from HDFC Bank, and that's happening from last 4 5 quarters actually. No
mm,
other bank is able to grow beyond 10 12% on deposit growth. So when we see it that way, I think they were prepared for somewhat on this, and they were building their liquidity coverage from that perspective from a good amount of time. So by the time I think they get into merger, LCR should not be a too much of worry for them. So say credit CRR and SLR both way. Maybe because mandatorily SLR will slightly go higher, then
mm.
to some extent, yeah, they'll have that low yielding part also.
Okay. Lastly, I just wanted to touch upon the subsidiary angle now. There, specifically with regard to the life insurance and general insurance companies, there the RBI has allowed them to hold about 50% for some time. They've also allowed them certain dispensation with regard to the education finance subsidiary of HDFC Limited, Credit. I just wanted to get a sense from you. All of this, you mentioned earlier that it removes certain overhang, but how does this help the bank?
So if the company going into the bank, and if bank would have said, RBI would have said immediately that like Lombard and other things have been asked that you need to bring it down to 30%, it would have been a big drag, because
Hmm.
both for these two companies also, which are there, HDFC Life and HDFC this, and there from their perspective also that impacts their SOTP. So one time cash flow will come, but structurally SOTP valuations would have got gradually impacted.
Right.
So when we look at the bank being allowed this 50% plus
Hmm.
removes overhang and also strengthens these subsidiaries, because bank is going to be the major partner for distribution. So strengthens these subsidiaries on the distribution side. And I think still the timeline is also not given. Maybe at the date of final approval, RBI may give some timeline what needs to be done with the stake. That's I think secondary part as at this point in time. But I think HDFC Life per se sees a big overhang going out.
Hmm. 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 Lastly, before we close this, I just wanted to get a sense about what the housing finance market looks like according to you, because now this big player is going to go out of the market. You're going to be left with much significantly smaller players, because the others in the housing finance market are nowhere close to where HDFC Limited is. Just your overview on
Yeah.
what the housing finance looks
I
like.
think yeah, retail was anyway strong across, and banks were already there competing with everyone, and
Yeah.
HDFC Limited also. The main thing that happened is such a large player for the developer portfolio never existed. If this player goes out, then I think the developer funding from that angle, getting a larger check from an NBFC on this developer or these portfolios, maybe though he was doing LRDs and all, but still getting those checks from banks is not so easy, because banks have their limitations on what they can do on the commercial real estate portfolios. So that is why I think this is a one good yielding opportunity which was there with HDFC Limited will not exist too much with HDFC Bank as a portfolio, and
Right.
may be difficult for funding from for the players basically when they
Hmm.
want to come forward. Even the good rating, good profile, still getting a larger amount from one player will be difficult for them. And if you look at overall housing segment, I think retail will continue to do well. I think even now also 12 to 15% credit growth on housing segment is happening.
Yeah.
And that I think on the housing mortgage portfolio should continue. Lab put together should be a becomes a better yield also. because pure home loan, there is a lot of competition. So I think home loan plus LAP is a combination which will, I think, continue to grow even now. I think 12 to 15% should be the range.
All right. Thank you so much, Kajal ma'am, for joining us on this call. And thank you so much for watching.
Thank you. Thank you very much.